Hey folks, welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This Weekend Technical Analysis Update for Monday, December 19th through Friday, December 23rd, 2011 is sponsored by Realtik. All right, guys, let's get right into the mix today. This is a chart of the 10-minute SPY, which tracks the S&P 500. Now, the key is I showed you this chart specifically on a zoomed-out basis. So what you're seeing is Monday, Tuesday, Wednesday, Thursday, Friday, because I want to give us a sense of what the market did last week, the direction it kind of went in. And what you can see is early in the week, we saw some selling. All right, Monday, Tuesday, Wednesday, selling. And then Thursday, Friday, consolidation and sideways action. Really, again, from the gap down or early push down, even on Wednesday, you just went sideways the rest of the week. So, again, early downside in the week, sideways, neutral markets the rest of the week. Now, again, the question is, where is the market going? What does this tell us about where it's heading? And bottom line is this: when you look at the chart and you zoom out even further, what you see is a major move up and then consolidation on the downside. And I can show this even better on the 60-minute chart. Here's your major move up, and then what you want to do is you want to take these pivot lows and draw a trend line and notice how it connects through all those pivot lows. So you have 1, 2, 3, 4, 5. All right, and that's telling you that again, it's a very controlled pullback. All right, and what that also tells us that eventually the market is going to turn around here towards the end of the year and head higher. And again, my projections right now are showing a pivot top of 127.5 of resistance, then on the SPY 129.50, and then possibly by early January 132 to 133. But again, keeping it short term, you have an up move, a small pullback here, and again, inside of the up move, this is considered in spirit of bullish consolidation. Now, the key is to go one step further and say, okay, well, if over the next 2 to 3 weeks we're going to generally trend up, what about early next week? What could happen Monday, Tuesday in the markets? And that's what we have to do to look at the tighter time frame. And what I want to do is go to the daily chart. The daily chart of the SPY is very giving in terms of what it's showing us and where this market will go. First off, you can easily see the consolidation pattern off of the big up move. There it is again on the daily chart of the SPY, which again is the S&P 500 essentially. So the up move consolidation, this is telling us the macro direction is up in the market. So the macro, meaning longer term, is positioning itself for a move up. However, in a shorter time frame, if you just want to isolate down in the micro setting where the market will go early, you have to note that you have a consolidation pattern off of this down move right here, which is bearish. All right, and most people would say, well, wait a minute, bearish and bullish. One thing is bullish, one thing is bearish. How do you read that? How does it tell you where the market's going? And what you do is you look at the micro pattern, and the micro pattern dictates the early move, meaning that the initial move, possibly Monday or Tuesday in the market, could be slightly lower. And if you do head slightly lower, it plays out right to this red trend line here, which is a master support level. And that's at 120 on the SPY. All right, so again, the micro pattern is telling us maybe Monday-ish, maybe a little downside. The macro pattern, which is the bigger move, will tell us that later next week and going into the holidays, the market is going to start to turn around to the upside. All right, so I hope everyone understands that, how I'm laying that out. There's a difference between macro and micro. The micro, maybe a little bit more downside, not much, but a little bit more based on the pattern. And then the macro pattern, the bigger pattern, is telling us further upside. All right, so that's what the market is telling us here. And again, we just got through an options X week, so we're now back to more normal markets where there's not so many games being played. We're looking towards next week to see what happens in Europe. Europe is still controlling this market. And again, the reason why Europe controls it is because essentially whatever happens in Europe, the market is still concerned that it will affect the U.S. economy. And obviously, the way it's affecting it is, well, if things are bad in Europe, things get worse in Europe, the euro falls, the dollar goes up, and the markets work inverse to the dollar. So if you want to know where the markets are going without looking at what the indexes are doing each day, just look at the dollar. If the dollar's down, the markets are up. If the dollar's up, the markets are down. And again, whichever way the euro is going, the dollar's going to go the opposite way. That's just the way the currencies. Right? Currencies have to float against each other, so if one gets bigger, the other has to kind of come down a little bit and vice versa. Okay, let's take another look at a couple other things here. And by the way, folks, before I get into more hardcore analysis here using proprietary techniques and such, I just want to remind you there's a 7-day free trial to the Research Center at inthemoneystocks.com and the intraday stock chat at inthemoneystocks.com. All right, the Research Center is geared more towards the swing trader, the investor. All right, this is more towards someone that works during the days and is more looking to hold a position for multiple days or a day or two. All right, sometimes my swing trades last 2 days, 1 day, sometimes they last 2 weeks, 1 week. And that's what generally people that work at full time jobs do. They can't be in front of their computers day trading, so they need the research center to give them their proprietary setups and trades, which I post my proprietary trades that I'm taking myself in the research center as well. Right now, if you're a day trader and you're sitting behind your computer all day and you can listen in on the stock chat and look at our screens live, then you come join us and take the 7-day free trial to the intraday stock chat. The beauty of the intraday stock chat, folks, is that you're literally sitting behind one of the expert traders, myself or my partner, as we trade the markets. You're watching my screen as I'm analyzing charts, giving out trades, answering questions live, and so forth. Live charts, live video, folks. That's what it's all about. And you can ask questions throughout the day whenever you feel like you don't understand or you have a question on a stock or you think you have a good trade, you want me to analyze it. That's what the intraday stock chat is for. And again, it's a 7-day free trial for that. All right, now let's get back into the hardcore analysis here. So that's what the market's looking like. That's the market in general. What I want to do next is take a look at certain charts. Let's first start with Amazon. Now, Amazon's significant because it had a monster reversal here on Wednesday. Wednesday, believe it or not, I had a master level at around $75. It comes down just below 75 and reverses. It was a great call. Some people in the chat room made a lot of money that day on that call. All right, now again, the 175 is right here. We can draw a line right in that vicinity. As you reversed, the impressive point of this is that you created what's called a bottoming tail. A bottoming tail is a key tail which is called for a reversal. All right, it calls a reversal in a stock. Just like a topping tail would cause a top in a stock, a bottoming tail is calling a bottom. Off of this move, you've had 2 consolidation days. The key is Amazon at this point on any pullback is a buy as long as it does not close below the tail low here. If it closes below the tail, that negates the bottoming tail. If you pull back here, 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 or even up here, that's telling you it's a buy as long as, again, it does not close below. And that's what I'm going to be looking to do myself. So on pullbacks, Amazon's a buy as long as you do not close below the tail. Upside resistance, target 1, 20 moving average, which currently sits at 190. And if you get through there, this pivot top right here with the 200 moving average just above right here is target 2 at 201, 200 even number. All right, so again, beautiful little setup right here. The key is, for me, I need to see a little bit of a pullback before I buy Amazon. Okay? A lot of people would just chase this, which is okay. It can go straight up too, don't get me wrong. But for me, I want to buy on a pullback as long as it does not close below that bottoming tail. That's the true way on expert trades, because essentially the reasoning behind it is if you bought here, yes, it could go up to the 20 moving average, of course, but your upside there from current levels is only about $8, $8.50. Your downside before a stop out, which would be a close below the 20 moving average, is a total of from this pivot low, which is at 171, all the way to 181. That's a $10 risk. So you have an $8.50 reward to a $10 risk. Risk reward is not in your favor there. All right, whenever you're taking a trade, you should be able to make more on the trade than you could lose. Okay? That's how you keep a trading book which continues to spit out profits. So again, for me, what I would look to do is a pullback somewhere in the 175, 177 range. Then I have a smaller stop on it, and the risk then the risk is just down here, right? I mean that's a tiny little risk, and reward is all the way up to the 20 moving average. Look at the difference in size there: small candle or small line versus large line. Okay, and this is just analysis that we start to do. We start to train you on this. We start to give you trades based off of this. Okay. All right, so that's very, very important. One stock that I'm also looking to get into is First Solar, FSLR. First Solar, most people are very bearish on. Analysts are bearish, everyone's bearish, everyone hates it. When everyone hates something, I start to like it. That's how I've made a living. I've made millions on that. All right, now the key is, again, to recognize that as you come down here, You had a nice reversal on Friday. You can't really see it on the daily chart, but I want to show you on the intraday. Look at this reversal on the intraday. Now, again, First Solar came out and warned last week. It was not a pretty week for the stock itself, but look at the reversal here. Thursday, you made a low and you had a decent little bounce back. Friday, you retested that low and you reversed and closed positive. Double bottom holds, reversal to the upside. The stock is down from $175 at the 52-week high this year to now $31, $32. I believe a bottom is in here, a longer term bottom. Risk, what would your risk reward be on this trade? Risk reward, well, let's take a look at the risk first. We always want to look at the risk. That's the number one thing, folks. Risk here would be a close below the double bottom here would be a stop out. So essentially you're talking about at $29.90 to $30. That would be your stop out if it closes below there. All right, right now it's sitting at $31.91. That's about a $2 stop. So a $2 stop on a $30 stock, it's about 8% or so. Not bad. All right, 6, 7, 8%, right in that general vicinity. Upside, what would be my target? Well, if you go to your daily chart and look at resistance levels, your first resistance would be right here, which is gap window, and then gap fill would be second. First resistance is at $38. So you're talking about a $6 gain just to first resistance. And if you go to the $40 level, you're talking about an $8 gain. So $6 to $8 on the upside versus $2 on the downside. Do you guys see how that fits? That's how the risk reward should be played. All right, so again, I just wanted to go through a couple little examples here, give you guys ideas about risk reward and how to analyze it properly. And again, you must know technical levels. All right, a lot of people out there use fundamentals. It's nonsense. And I know there's a lot of people out there that, love them. But to be honest, depending on what market, if you're in a bear market, the S&P, PE can be 8. If you're in a bull market, it could be 15, 20. That doesn't give you a good fundamental analysis because it's based on the type of market you're in. What you need to do is follow the charts. Right? That's how I've made my living, and that's how I'll continue to make amazing amounts of money, as well as my subscribers here at In the Money Stocks, as I teach them my proprietary methods. All right, the proprietary methods here, folks, institutions don't know them. Hedge funds don't know them. Fund managers don't know them. The average person doesn't know them. We are teaching it to the elite crew here at In the Money Stocks, which are members that have decided to step up to the plate because they're sick of losing money by listening to the Wall Street hype. You step up, you profit, you learn. All right, we'll teach you everything. I don't hold back anything. I'll teach you the methods. All right? This is just a small insight into what we do here. You join the research center, you take that 7-day free trial, your world will open up and the profits will flow through. All right, so again, come join us here, 7-day free trial, inthemoneystocks.com, Research Center, Intraday Stock Chat. Those are the only two main services you want to think about right now. Come take the 7-day free trial and profit with the elite pros. Take care, guys.